In 1815, the Battle of Waterloo decided the fate of Europe and, according to legend, transformed financial markets. Nathan Rothschild, the legendary financier, is said to have leveraged an extraordinary network of couriers to gain news of Napoleon's defeat ahead of the rest of London. What Rothschild allegedly did with that information remains a case study in the power and peril of asymmetric information. This historical anecdote offers a timeless lesson. In financial markets, knowledge is power. However, when knowledge is distributed unequally, a phenomenon economists call asymmetric information, it creates opportunities as well as systemic risks. Let's explore how asymmetric information shaped Rothschild's time and how it manifests in today's markets. As the story goes, Rothschild's private courier network enabled him to learn of Napoleon's defeat before anyone else in London. This asymmetry gave him a critical advantage. Allegedly, Rothschild sold his government bonds, signaling to the market that the British had likely lost. Panicked investors followed suit, driving prices down. Rothschild then repurchased bonds at steep discounts. When the news of Napoleon's defeat finally reached the public, bond prices surged, netting Rothschild enormous profits. While historians dispute the exact details of this story, the principle is clear. Exclusive or early information allows savvy individuals to exploit market inefficiencies. In the 19th century, this meant leveraging physical networks like couriers and secure channels. However, the Rothschild story also highlights how human psychology, such as herd behavior, amplifies the effects of information gaps. Fast forward to today, and the mechanisms of asymmetric information have evolved dramatically. Despite advancements in technology and globalization making information more accessible, gaps remain, and they have grown more sophisticated. Here are 3 examples. Insider trading exemplifies the exploitation of non-public information. When corporate executives or insiders act on proprietary data, they gain a significant advantage over retail investors. For instance, during the rise of meme stocks, retail investors expressed outrage over perceived informational advantages held by institutional players. High-frequency trading, or HFT firms, use algorithms and advanced infrastructure to execute trades within milliseconds, exploiting tiny pricing inefficiencies. While not illegal, the speed and sophistication of HFT create a structural advantage unavailable to most retail investors, exacerbating information asymmetry. Beyond financial markets, asymmetric information thrives in the digital age. Tech companies hold vast amounts of consumer data, allowing them to influence pricing and advertising. Consumers, lacking equivalent knowledge or control, face an inherent disadvantage. Asymmetric information isn't inherently negative. Financial markets rely on differences in knowledge and perspective to drive transactions. However, problems arise when the asymmetry becomes systemic, distorting market outcomes. For example, the 2008 financial crisis, banks and rating agencies held far more information about the risks of mortgage-backed securities than the general public. This information gap exacerbated the economic fallout when the housing bubble burst, leaving taxpayers and ordinary investors bearing the brunt of the collapse. Governments and regulators have long attempted to address asymmetric information through measures such as insider trading laws. These aim to ensure a level playing field by prohibiting trading based on non-public information. Disclosure requirements. Public companies must regularly disclose financial performance and risks to mitigate information gaps. Global challenges. In a globalized economy, differing regulations across countries create loopholes that exacerbate asymmetry. However, challenges persist. Complexity of financial products. Many financial instruments are too complex for average investors to fully understand, even with disclosure. AI and big data machine learning tools allow firms to analyze data at unprecedented scales, widening the gap between institutional and retail participants. For modern investors, asymmetric information remains an unavoidable challenge. However, several strategies can help mitigate its risks. Understand your position. Retail investors should recognize their informational disadvantages compared to institutional players and avoid overextending based on incomplete knowledge. Diversify investments. Spreading investments across different sectors and asset classes reduces the impact of misinformation or market distortions in any single area. Leverage publicly available tools. Use resources like SEC filings, earnings calls, and free financial analysis platforms to narrow the informational gap. Follow regulatory updates. Understanding changes in market regulations can provide insights into areas where asymmetry may decrease. The tale of Nathan Rothschild, whether fact or fiction, underscores an enduring truth about markets. Asymmetric information will always exist. The challenge for investors is to recognize these gaps and act strategically. Just as Rothschild used his informational edge to navigate uncertainty, today's investors must use available tools and strategies to manage risks and capitalize on opportunities. Markets may evolve, but the dynamics of information and the need to stay ahead remain constant. At Enki Advisors, we aim to empower our readers with actionable insights to navigate these complexities. Stay informed, stay strategic, and remember, forewarned is forearmed.